Hi friends, welcome to the NPTEL course Strategy and Technology, a practical primer. We are in week 4 with the theme of competitive strategy. In this lecture, the 18th in the series, I will focus on liquidity as the sixth force. We have discussed the 5 economic forces model in the previous lecture. In this lecture, we will focus particularly on liquidity, which is the most potent economic force. The idea in this lecture is to explore how this force by itself can reinforce the 5 forces model. That's because some companies and some strategy analysts would find it difficult to have a separate model of 5 economic forces and then derive an industrial forces model from that. I am trying to propose here that we will bring in the liquidity factor as the sixth force relevant to supplement the 5 forces model. The response by the central banks to the global COVID pandemic indicates that the lessons of the 2008 financial crisis have been learned. The central banks have recognized that liquidity is the most critical input that is required to protect and stabilize industrial and other institutions and societies in periods of economic crisis. While the 5 economic forces model is the most comprehensive way to deal with the economic forces impacting the industrial development, we could probably look at global liquidity as one of the most critical and most appropriate forces if the 5 forces model alone has to be experimented with. The elasticity of system liquidity to economic downturn or upturn would be a critical parameter affecting firm-level competitive strategy. Let us therefore delve deeper into the significance of liquidity in influencing industrial structure and strategy. The 5 industrial forces to recall are the threat of new entrants, threat of substitute products or services, bargaining power of buyers, bargaining power of suppliers, and intensity of industry rivalry. The 5 economic forces, again to recap, are threat of inflation, power of global capital flows, bargaining power of national technologies, bargaining power of national markets, and intensity of national rivalry. We also considered in the previous lecture how each economic force has a significant impact on how industry and business level developments take place. We also established the linkages between the economic forces and industrial forces that Porter outlined. The common thread among the 5 economic forces is that they are influenced by and they are susceptible to government policies. For example, the decision of the Government of India to withdraw high-value currency notes to flush out black money is a prime example. The decision to move towards a less cash society and eventually a cashless society through digital payments opened major opportunities for several companies, including but not limited to digital payment, fintech banking, and reskilling business, while challenging the industries and businesses that were based on cash transactions. So that is the impact of any government policy on the economic system and the industrial system. Let's look at global liquidity. Government policies in respect of any nation are constantly seeking global superiority, even as the relative economic performance of nations ensures that global economies are in a state of perpetual disequilibrium. What it means is that there is no equilibrium to perpetuity in global economies. Every nation tries to get the better of the other nation. In this game of global superiority, relative economic performance of nations decides the pecking order of different countries and different economies. Governments and central banks are convinced that global liquidity must be maintained to ensure that the despondent forces of disequilibrium are overcome by the euphoric forces of growth. Now, this is a balance. Liquidity drives consumption, which drives inflation, and inflation harms the industrial system. Much as liquidity is required to support institutions and enhance industrial growth, excess liquidity is also deleterious for economic stability. Whether it is Greece at one extreme or the UK at the other, austerity as an economic policy has caused social hardships and consequently has come under public criticism. Similarly, whether it is the USA at one end or Japan at the other end, quantitative easing has been at the core of economic revival. If one were choosing an economic force that can be labeled as the most important economic force, it would be global liquidity. For those strategists in small and medium enterprises who would probably be more comfortable with a single model, global liquidity can be added very appropriately as the sixth competitive force to the conventional five forces model. That is the appropriateness of global liquidity. All industrial development or economic development, and unfortunately to an extent all social development, is also Darwinian in its philosophy. The implicit essence of Porter's theory is that corporate competitiveness plays a win by some, lose by some play, whereby competitively robust and agile firms alone will sustain themselves and grow. I would say that in a sense, Porter's theory heightens modern corporate Darwinism, where only the fittest would survive. While inequalities would persist, there is now a greater awareness than ever before that every person or entity in the global system deserves a place under the sun. Global liquidity, which flows from developed markets to emerging markets based on opportunities, is a great investment and great instrument to elevate needy markets. While Porter's theory is an excellent guidepost for industrial development, we can fortify the model further by incorporating economic liquidity as the sixth competitive force. So whether you look at the Fortune Global 500 firms or S&P 500 firms, it is the competitiveness that drives the firm's ranking and also firm's staying power to perpetuity. So without disturbing or distracting from the economic rigor that Porter brought to corporate strategy, we may also say that true economic growth must be based on foundations that are more broad-based, foundations that are more sustainable, an approach that suggests, if not endorses, the survival of the fittest doctrine. What is sustainable economic growth? Sustainable economic growth is one which envisages equitable growth of all sections of the society and the profitable coexistence of different types of firms. And those firms could be single product, simple firms. Those firms could be global conglomerates, local micro enterprises, as well as highly networked multinational companies could be requiring sustainable economic growth. Similarly, from the point of view of people, business leaders to frontline workers should have an equitable existence. Similarly, coexistence of formal and informal sectors is also equally critical. So it is always a toss-up between recession and stimulus. If we do nothing about recession, then the industries will go down and there will be huge unemployment and therefore social inequity and unrest. Recession can be countered by stimulus, as we have seen in 2008-10 global financial meltdown and also in the recent COVID-19 pandemic-induced economic recession. There have been debates all the while in developed markets and even in the emerging markets on budgetary austerity versus monetary expansion, which is good. In our own country, we have understood and decided that rigorous control of fiscal deficit is not appropriate when countries are faced with unusual circumstances and when keeping livelihoods is more important than keeping certain monetary statistics under control. So in a globally connected world, macroeconomic stimulus measures are an essential component of global stability. We have seen that business inefficiencies and corporate mismanagement have from time to time led to an unprecedented evaporation of economic wealth. This economic meltdown has shaken advanced and emerging countries to the roots. The industries and societies can be swept away if economic liquidity is ignored by incumbent firms in crafting corporate strategies and by regulators in assuring governance standards. So economic liquidity and the judicious use of the liquidity is important for orderly industrial and economic development. We have had deep economic recessions. We have seen failures by global corporations. These have led governments to inject trillions of dollars to arrest economic collapse and ease liquidity crisis. Too big to fail has been one mantra which came up during the previous financial meltdown in 2008 and 2010. but the big have to take proactive measures so that they are governed in an appropriate manner and they have no failure of operations. The response from the governments to support institutions has been very strong to meet COVID-induced economic contraction. The central banks have been very quickly on their feet to provide the stimulus measures of different varieties and constituting, as we have seen in the previous lecture, anything between 10 and 25% of the GDP. Even post-COVID, liquidity will remain the most important competitive factor. So sustainable economic growth is dependent on judicious availability and use of liquidity in the system. What is economic or system liquidity? Firms exist because their products and services will be stimulating as well as fulfilling the customer needs. And that has a virtuous increasing cycle. That's how the world learned to grow. Customers embrace additional and new products on a continuous basis to elevate their standard of life, their quality of life. Governments are committed to economic growth and therefore have a stake in the propagation of this virtuous corporate customer relationship. Firms and customers require each other mutually so that the resources are available to ensure that the firms have cash flow to invest in products and services. There are respective obligations of manufacture and consumption. The level and sustainability of economic liquidity in the value chain of a firm is an essential competitive force. This economic liquidity is not merely the cash flow that comes out of manufacturing and supplying products and earning revenues. This concept of economic liquidity is much larger and much broader than that. The 5 competitive forces for a firm, as outlined by Porter, differentially affect and are affected by the competitive force of system liquidity. When finance becomes scarce, the intensity of rivalry for resources increases. It is no more the intensity of rivalry between companies to put in to the market new products. The intensity of rivalry is essentially in terms of accessing resources and creating resource buffers to be able to meet the vicissitudes of the economy. This further pushes down the availability of finance and pushes up the cost of finance. This hurts industry structure as well as the firm strategy. So economic or system liquidity is dependent on a number of factors, and particularly the more the system is flush with funds, the lower will be the cost of capital and therefore there will be better opportunities for growth. But too much of money in the hands of consuming sections of the society could also drive up inflation. What are the select sources of liquidity? For the same 3 constituents we have considered of the economic system in the previous slide, we can also note that there are very distinct streams of liquidity. When these sources dry up or overflow, liquidity becomes a major economic force, negative or positive correspondingly. As far as customers are concerned, their savings from their incomes, the dividends they get from their investments, and the monetization revenues when they monetize their assets. This is the revenue stream for the customers and the contributor for the liquidity. For the governments, taxes, dividends from public sector undertakings, dividends from the Reserve Bank of India and other banks, foreign direct investments, deposits, interest, these are all the income streams. For firms, equity, debt and profits are the income streams. We also have several types of debt, convertible, non-convertible, perpetual and so on. For a balanced economic system, the household savings should support consumption and maintenance. Government's revenue and capital receipts must support expenditure and investments. These are the fair principles of balance between investment and expenditure in social structure as well as in the governmental structure. Firms' profits should service equity and debt. Equity and debt, of course, should support the firms in establishing facilities, creating intellectual and physical assets and selling them for the customer benefit. When liquidity overflows, the above prudential principles are ignored. Companies resort to debt-driven expansion because debt is always more easily available than equity for companies. And they also pursue aggressive diversification and modernization because of the availability of cheap capital. Equity also chases market opportunities rather than realistic profits, which is one of the reasons why startups have received huge dollops of funds even though their business models have not been profitable. So these are the effects of excess liquidity in any system. Let's consider this further. In an environment of economic stringency, customers move away from high-cost premium products and start entertaining low-cost functional products, and firms are faced with increased receivables. Therefore, there is a mismatch between production of certain products and consumption of certain other products. Similarly, the firms face mismatch between the debtors and their own payables. Monopoly suppliers dictate their terms of supply in such situations, while fragmented suppliers suffer extended working capital cycles and they have uncertain payments staring at their face. When this system liquidity is volatile or is constrained, new product development suffers. New entrants delay entry plans, and this has impact 2 to 3 years down the road, and customers are at a disadvantage in the future. Greater industry volatility and lower industrial profitability characterize such an industrial system. The velocity of circulation of capital comes to a screeching halt. The importance of the velocity of circulation of capital cannot be underemphasized. We need to have a working capital cycle which turns over products at a fast clip, and that has to be very smooth, seamless, and should not be subject to either debt bubbles or demand bubbles. The financial sector, which comprises banking, non-banking finance, home finance, microfinance, insurance, refinance, private equity, venture capital, mutual fund, pension fund, hedge fund, and stockbroking firms, see the extent of the financial institutions available. They all face a quick and inexplicable evaporation of capital in an environment of downturn. When the chips are strong, there will be so many avenues of investment. You would be flooded with loan schemes for cheap home loans. There will be so many enticements that there could be a trade-in of a product. There may be so many proposals that you did not pay equated monthly installment until you move into a house 3-4 years down the road after the construction is completed. There will be many such dispensations offered to the customers because the people who are offering those services and products are backed by excess liquidity. The financial sector also moves in tandem with those kinds of activities. Much of the investment that has gone into the new age IPOs or broadly in the recent IPOs has been funded by loans provided to the high net worth individuals by the non-banking financial corporations, which probably is not a great idea. And when this happens, as long as the bubble keeps on expanding with lofty valuations, there will be more of such trade coming in, there would be more of oversubscription, there would be more of grey market for those scripts, and there would be more of high value listing after the subscriptions are closed and the new companies are listed on the stock exchanges. But one setback, as we have seen with the taper announcement, would see that the finance dries up and suddenly IPOs are shunned. The listings take place at nominal or below par subscription, and even after subscription there could be poor or tepid listing. There has been one public issue which could not be closed to the desired level in the insurance space. Only about 75 to 80% of the issue funds has been subscribed, and therefore the issue had to be curtailed. So suddenly the liquidity could change from highest level of availability to medium level and even to the low level. So leveraging and playing upon debt is always a risk for the economic system. In addition, the instruments that are deployed to play in these markets could be causing further volatility. Leveraging and derivative instruments with speculative elements collapse as the system adjusts to align a virtual world of escalating financial value with the physical world of excess assets. Capital output ratios suddenly turn awry and adverse, leading to non-performing assets and eventual bankruptcies if they are left unchecked. This is the challenge which comes out of imprudent generation and circulation of system liquidity. During the times of COVID, the household liquidity had a major downturn. There has also been demand churn in household patterns. When household liquidity dries up, as it happened due to COVID pandemic, there would be a churn in consumption demand pattern, and that would have an impact on industrial structures and firm positions. This is a chart, probably a little difficult to read, of how in different countries things have moved from favoring one type of goods to another type of goods. Spending on home essentials rockets up. Spending on personal discretionary items is held back. Focus is on responsible, no-frills spending. Slump takes place in real estate, tourism, entertainment, and hospitality, etc. Economy and industry are at a loss with huge capacities built. In COVID times, you have seen that whatever was discretionary was purchased or used much less compared to what was essential. Those which provided quality of life, be it tourism, be it hospitality, be it movie theater experience, be it restaurants and parties, all of these things have skyrocketed in the pre-COVID era, but they all had a significant downturn in the COVID era. Huge shifts have therefore taken place, and some of those churns are there to stay. These shifts may deepen, revert to pre-COVID situation, or an entirely new pattern may emerge. The strategy leader must hold both the torch and the wheel for the CEO and the firm. Linking household liquidity to public emergencies or economic conditions, and also seeing how demand churn impacts household liquidity, is one of the important tasks for industrial managers and industrial strategists. Global consumers anticipate pulling back when crises are staring them at their face. The same global consumers may splurge when they feel that the crises have passed. These shifts have to be understood on a regular basis by industrial managers and strategists. And to be able to do that, we need to understand models of household liquidity and demand churn related to economic consequences of events. Needless to say, stringency or buoyancy unrelated to economic fundamentals causes irrational socio-economic behavior amongst all shareholders and stakeholders. Often it falls on the governments and central bankers to moderate it. For customers, liquidity essentially exists through the cash they have and the credit they can generate. When I talk about cash, it is not physical cash with the people. It is the cash that is available through bank accounts, through other liquid financial instruments. Each national and economic culture has its own savings and consumption culture. The great American housing bubble of 2007 and 9 has demonstrated how a credit-driven market exponentially and speculatively expands until an economic downturn leads to institutional collapse, and with it the total market collapse. This is not the first time that an asset bubble has caused significant downturn in the prospects of an economy and of a society. In Japan also, huge real estate and investment bubbles in the 1970s caused the economy, which was under high growth path, to get into a long period of deflation and stagflation. The global consumer is today more appreciative of the need to lead a life that is meaningfully deleveraged and which is sufficiently savings driven. Global governments are more open to managing the risks of monetary expansion, even if it is pro-stimulus. Consumers were certainly caught off guard in the global financial crisis of 2008, But this time the consumers were more resilient in the face of COVID-19 pandemic and the economic lockdowns. Although the events were sudden and inexplicably confusing, but the citizens as a whole were able to stand up to the economic crisis that unraveled. To experience the system liquidity, we need to look at certain examples. For a firm that is a part or contributes to the 5 components of the 5 forces theory, liquidity exists in terms of not only in terms of equity and debt, but also in terms of various assets it holds, from research and manufacturing assets to intellectual and goodwill assets. When required, these can be monetized to redress the liquidity situation. Industrial development, industrial strategies must therefore look beyond creating only products and deriving cash from them. Firms should look at creating intellectual capital, creating facilities that will be useful for a wide range of products, creating people competencies that could generate greater value in tough times as well as in good times. The manner and value of the acquisition and nurturing of these assets and the speed and effectiveness of their commercialization or monetization will determine the system liquidity that a firm faces. Unfortunately, true economic value is rarely placed on or leveraged from such non-cash assets until a major event like a merger or acquisition, for example Nokia, or bankruptcy, for example Kodak, occurs. Vodafone Idea has been another example. It has been hoping to raise $1 billion, about rupees 7,000 crores, from the sale of its fixed line broadband subsidiary, optic fiber unit and data centers business, as it seeks to generate funds to meet upcoming liabilities. Ultimately, governmental measures to rethink the revenues from the telecom companies have helped to shore up liquidity, and that liquidity lifeline provided by the government has helped Vodafone Idea to stay afloat. The experience of Vodafone Idea points to the importance of system liquidity in any industrial development and in any industrial management. Let's look at the 2 cases of Reliance Jio and Vodafone Idea in greater depth. Both are in the telecommunications space. Vodafone Idea has been present, as I said, from the 1990s, whereas Jio entered the field in 2007. Reliance Jio and Vodafone Idea represent 2 highly contrasting tales of liquidity management. Reliance Jio created value through debt, built 4G infrastructure and deleveraged at the right time. Vodafone Idea developed debt, built 2G infrastructure, lost value by sticking to the outdated technology, and piled up debt. Vodafone Idea was first established as Idea Seller in 1995 and had many changes, while Reliance Jio was a more recent company that was established in 2007. The strategy cycles of both the companies was evident. Raise debt, create 4G infrastructure, use price to capture market, shake up industry structure and raise equity to deliver. That was the Jio strategy. Vodafone Idea strategy was raise debt, stay on with 2G, 3G, fail to provide for AGR, other dues, fail to raise funding on time and therefore become vulnerable to competition and even have questions on going concerns. Reliance raised a record rupees 3.24 lakh crores, that is an equivalent of $44 billion in 2020 to become debt-free, whereas Vodafone Idea struggled to raise finances and is now required to raise minimum rupees 70,000 crore. The contrasting tales which are highlighted here, they underline and validate the importance of technology and leadership in ensuring that a firm's destiny is carried out in a prudential manner. If that is not done so, and if excessive liquidity is sucked in to make unproductive investments or stay on with outdated technologies, it would end up making the firms vulnerable. And in the overall, the industry itself could be shaken up through such practices and incumbents could face downfall. As I said, Vodafone Idea was one of the earliest large companies in the telecom space that was established in 1995. Originally, it was called Idea Cellular Limited and underwent many transformations to the current state. In the process, it was hemmed in by funding shortages, and it could not invest in modern telecom gear. There was also non-alignment of joint venture partners on what it takes to succeed in the world's largest telecom market. There are 4 reasons and 4 exemplifications of Vodafone Idea's plight. 1. Lack of right technology, non-agile reactive management, lack of prudential provisions for statutory dues. The liquidity concerns therefore cumulatively snowballed to destabilize VI. The balance sheet said that 23,400 crore, that is $3.1 billion of cash shortfall would be faced by VI until April 2022. It also said that 22,500 crore was due during December 21, April 22, 4 months, toward AGR, regular debt and spectrum dues. 350 crore is all that Vodafone Idea had as cash balance as of March end. 30,000 crore is the Vodafone Idea's total repayment dues estimated to be effected by March 2023. So you can imagine the gigantic nature of debt problem that Vodafone Idea faced. Government India had stepped in. That was after several competitive forays by Jio shook up the industry structure. After tough legal battles between the Department of Telecommunications and the Airtel and Vodafone Idea telcos on recomputation of dues, and the inability of the Vodafone Idea management to raise funds, the Government of India stepped in. It provided a relief package that comprised moratorium on AGR dues, deferred payments and conversion of interest into equity stake by the government. Although it was system liquidity that was provided, VI was a major beneficiary of this system. So system liquidity helps industrial development, and system liquidity can occur particularly in companies and industries such as these through governmental support. We have to therefore view system liquidity as the new force. In a growth economy of high potential, liquidity tends to be a factor of low concern because aspirational entrepreneurs enter. Capital flush financiers are there to support, and it gives an intoxicating feel to the economy. As we have seen in terms of new age enterprises getting listed at exorbitant valuations on the stock exchange, even though there is no profitability for any of the firms, say probably Nika, there is so much of enthusiasm for public issues that the prudential balance is often lost sight of. Firms and conglomerates, of course, need to grow based largely on debt, but prudential management of debt is very much important. VI case has illustrated that only agile and proactive as well as prudential management, when undertaken with appropriate technology, can provide competitive advantage. New age technology firms obviously grow on astronomical equity valuations. In no time, startups are becoming unicorns in India. That is more than $1 billion market valuation. The growth thesis in such circumstances, unfortunately, is based on external funding, whether equity or debt, rather than the firm's own cash generation. In good times, stock markets experience irrational exuberance on the back of liquidity flows, and these comprise stretched valuations and risky bets. The principle of productivity is erroneously applied, with firms seeking to do far more than what they can achieve through their internal cash generation. Models of corporate strategy, such as Porter's 5 forces model, therefore need to be expanded to factor in system liquidity as an overarching sixth competitive force. Structural analysis of industries and firm-level strategies need to integrate liquidity as an important influencer of all the forces. I would therefore suggest that the power of system liquidity should be seen as the sixth force that supplements the known 5 forces of the Porter model. That is, the threat of new entrants, bargaining power of customers, threat of substitute products or services, bargaining power of suppliers, and intensity of industry rivalry must be supplemented by the power of system liquidity. The power of system liquidity influences all the other four forces shown in circles and also enhances the intensity of industry rivalry. The six forces model considers the system liquidity as an aggregate financial factor rather than one particular revenue-based factor of a firm. All the four players in the industry, that is the firms, the customers, suppliers and entrants, together constitute the providers of system liquidity, and that is duly modulated by national and global government policies. When system liquidity is fed not only by the industry but also by the larger economic and industrial system, there would be great positive influence on the strategies of the firms, customers, suppliers. But that positivity must be utilized with responsibility. How do we factor system liquidity? We cannot consider system liquidity from the sole profitability viewpoint and on a standalone perspective. We have to consider it along with technology, strategy and other industry related factors. That's why the economic model and the industrial forces model are interlinked. Industry structure certainly drives competition and profitability irrespective of whether an industry is an emerging or mature industry, a high-tech or low-tech industry, a regulated or unregulated industry. However, these industries can move to the next level, that is, they can have breakthroughs or transformation while becoming emerging or mature. They can be disrupted or consolidated. They can go for standardization or customization based on the liquidity that is available. So firms in strategy formulation mode must consider front-end market dynamics, that is the interaction between the firm and the customers through product and services and receivables, and back-end industry dynamics, that is through technology, product development and manufacture, as two sets of collaborative factors. By focusing on the system liquidity as the sixth powerful factor, we bring in an essential value chain perspective and a desirable economic perspective to the firm level strategy formulation. Let us take some examples of system liquidity. In the trucking industry, the concept of system liquidity doesn't exist except in parts. Whether the operators have the finance to buy a vehicle, whether the operators have the loads to be able to run their vehicles. But we need to really integrate all of this together in one smooth system liquidity value chain so that the material and component suppliers, vehicle makers and the good transporters as well as the customers are benefited from the system liquidity. This would require different players to come up with different strategies but in collaborative combinations. Similar is the case with state transport undertakings. We all know that public transport system is not hugely profitable because ticket prices have to be kept low to enable the indigent population have social mobility. But at the same time, when we look at sale of buses as a transaction and operation of buses as a responsibility, we are not connecting the dots together. Here again, we need to have a total system liquidity plan covering the component makers, system suppliers who support the bus manufacture, the firms who manufacture the buses, and the state transport undertakings and the financial institutions, including the multilateral funding agencies, so that there is an integrated system liquidity plan and the public transport system can be more effective. Economic value is a total value chain that covers the extraction, conversion and delivery path from the most basic materials and components to the most advanced final product that incorporates the materials and components. So the concept of total economic value chain supported by system liquidity has to be envisaged, conceptualized by the strategic planners in different stakeholding groups of an industry. We know that Ford, Chrysler, GM have been the big three of the US automobile industry. We also know that collectively as well as individually, they lagged behind the Japanese counterparts. The weaker performance led to reduced liquidity, and lower liquidity constrained newer technological developments. This constituted a vicious circle for these big three. They did have these five forces models. They made those complex industrial analysis which Porter recommended. However, ignorance of the system liquidity paradigm that is well supported by a virtuous technological capability was ignored. that had to be broken. On the other hand, when you look at Toyota Motor and other companies in the Japanese national automobile system, they all turned out superior global performance because as firms they collaborated with these other stakeholders, including component makers, through concurrent engineering and just-in-time system. They collaborated with the customers through different kind of pull type demand system. They were economic and efficient yet elegant designs that appealed to the customers but also provided them the on-road user satisfaction. A total economic structure was thus created. One-time bailout happened in the US post the liquidity crisis in 2008. That made at least 2 of the 3 companies become leaner and fitter. On the other hand, companies which are run on virtuous mode all through their life from the inception remained on the path of self-funded liquidity, example being Toyota. In addition to the liquidity that is developed by an industrial system, there could be supply chain partnership that pools liquidity. In the past, supply chain sourcing was seen as a measure of compressing the procurement costs and adding value or taking away value from the supply system and taking the value into the firm's production system. That has resulted in failures of such value chains. Quality was at stake. On the other hand, companies which pooled supply chain with companies as well as their suppliers, they focused on quality sourcing and prospered. On the other hand, companies which focused on quality sourcing but also pooled supply chain partnerships had higher system liquidity and prospered. I have talked about Starbucks in a previous lecture, how they focus on coffee plantations as part of their global supply chain. Similarly, several global food and beverage makers prospered by including the farm sector in their strategic planning process. Indian agro product manufacturer ITC has proactive steps that are in place to implement a farm-to-fork strategy. High investment and high working capital firms in airlines, telecom, space projects and power utilities require proactive and collaborative partnerships with equipment maker and component vendors. In fact, we also need to have more forward-looking linkages. Positive relationships with the power equipment makers, power distributors and regulators achieve better financial closures and timely project execution. When we set up a thermal power plant or a renewable energy plant today, we also look at the PPA aspects, power purchase agreement aspects, both in terms of the quantum of units that will be produced and the price at which they will be bought and the escalating or de-escalating mechanisms for the power cost. We also have to keep in mind that mega transformations require mega liquidity. This is illustrated by the case of Mukesh Ambani's Reliance Industries. Reliance, without doubt, has the world's biggest refining complex at Jamnagar in Western India, and the company has decided to invest $10.1 billion in clean energy over the next 3 years, and the drive is to become a net zero carbon company by 2035. A part of this involves setting up 4 gigafactories to produce solar cells and modules, energy storage batteries, fuel cells and green hydrogen. The other leg of this strategy is to have several partnerships with the value chain participants and adjunct industries relating to its new energy business. And the third component is to have very firm targets, that is to generate 1/5 of the targeted 450 gigawatt renewable energy, that is 100 gigawatts by Reliance itself by 2030. Reliance plan mirrors strategies of global oil majors such as Royal Dutch Shell PLC and BP PLC. They have all set goals to become net zero carbon by 2050 amid pressure from investors and climate activities. Reliance is trying to go one step ahead by trying to become that by 2035. The world is entering a new energy era which is going to be highly disruptive. The age of fossil fuels, which powered economic growth globally for nearly 3 centuries, cannot continue much longer, opined Chairman Mukesh Ambani at the shareholder meeting on June 24, 2021. As firms become national assets because of their size, scale, scope, and the focus areas, the need for them to recognize system liquidity in a positive and prudential manner is becoming very important, because they are becoming so important and so huge to economic development, they cannot afford to fail. So as competitive force models are developed for these companies, we have to integrate system liquidity as the important concept and construct. Public purpose obviously cannot take sides on private matters. However, public policy and private enterprise are closely interlinked with each other. This makes the merger of economic factors and industrial factors, economic forces and industrial forces, an essential paradigm to make sure that industrial development supports positive national economic development. Not all liquidity-driven business models will pan out in the right manner. Dr. Reddy's acquired Betaform, one of the largest generic players in Germany. However, that acquisition proved somewhat disastrous for the company because the importance of economic liquidity was not appreciated by the acquiring company. The lack of liquidity in the European generics market was not envisaged. The changing procurement dynamics were not envisaged. And to make things worse, the valuation of the business was very high, and it was feebly supported by internal profitability, and it was generously aided by debt. This led to severe operational crunch on Dr. Reddy's for several years. Tata Steel made a very good acquisition of Chorus Steel European assets. However, this was unsettled by global steel economics on one hand and UK-specific economic pressures on the other hand. Despite the apparent homogeneity and synergy of the two businesses, that is Tata Steel's original business and the acquired European steel business, through technological, product and customer angles, the system liquidity was impaired. So as we want to become truly global, we need to keep up the expansion and acquisition spree, no doubt. But we also have to understand how these massive amounts of resources that are required for supporting those acquisitions and mergers will be prudentially obtained and prudentially managed. Certainly, success in one aspect leads to success in another, but successive failures could be calamitous for the companies, industries, and the economy itself. Therefore, the importance of system liquidity cannot be overemphasized. We could have opportunity-driven liquidity. As the economic policy liberalized from the 1990s, groups led by Mukesh Ambani and Gautam Adani saw enormous opportunity to drive stupendous growth in investment-intensive sectors through debt-fueled liquidity. Between 1990 and 2020, Reliance moved into retail, telecom, and oil. As a result of that, Reliance had a revenue of 659,209 crore as of March 31, 2020, with an EBITDA of 102,280 crore by that same period. However, the company accumulated a gross debt of over 2 lakh crore to fund expansion, which was there on the books by March 31, 2020, and long-term viability was becoming risky, and COVID pandemic unfolded itself with deleterious economic impact. Yet, in 2020, the company could raise 1.68 lakh crores in 3 months between April and June 2020 and could become net debt-free. This illustrates how, if assets are created in a technologically modern manner and are supported by strong management which provides an operating cash cycle, people willing to provide funds to such enterprises. Now, between 2020 and 2040, Reliance wants to move into renewable generation, renewable partnership, and renewable hardware, all related to renewables, renewable energy systems. For the new renewable energy drive, Reliance proposes to utilize Rs 70,000 crore, which means either the equity that is raised must be used or fresh debt or fresh equity needs to be raised. However, if a group has the strength of the company and the other adjunct businesses, if the assets are of high quality, there is a track record of managing, executing, running mega projects, and the need and opportunity of transforming into a renewal giant is in synchrony with what the country and the world demands, then there could be a opportunity-driven liquidity for the Reliance Group, and it could be even more expansive and more visionary than what has been outlined so far. Therefore, there could be opportunity-driven liquidity when the companies have solid background and equally visionary plans for the future. Another example is of Adani Group. Over the last several years, Adani Group benefited because of the policy liberalization, particularly the infrastructure space. As a result, the group, which was established in 1988, grew very fast in the more recent years to become a diversified conglomerate with focus on infrastructure. Probably there is no group which has got such singular focus on a diversified base of infrastructural projects. Its turnover in FY21 was 1.1 lakh crore, EBITDA was 32,300 crore, and debt was 3.3 lakh crores. You can note the high level of debt that is there. All the infrastructure projects are debt intensive or investment intensive actually, and you require equity, risk capital in substantial measure with high valuations to be able to reduce the debt. So most infrastructure sectors that were opened up had Gautam Adani participating: renewable energy, gas, ports, logistics, airports, food processing, data centers, mining, financial services. And the list is not ending. Adani has announced the idea to enter into the cement space, into the petrochemical space, and also into the aluminium space. And several other metal spaces are also on the agenda of the Adani Group. The group certainly has made one of the most audacious investment bets on infrastructure and built multiple national assets. But all of this has come from debt-fueled liquidity. And this factor cannot be ignored, because these are all so tied up with economic advancement of the nation. The group has to ensure that debt is managed in a prudential manner. While these opportunities provide good debt funding, these opportunities must also be used to enhance the overall system liquidity in a positive manner. That will be the key to success of Adani Group and therefore the success of the economic development. Opportunism-driven liquidity is the other side of the picture, the other extreme. That is, liquidity is available aplenty. Companies are courted by the banking and other financial institutions to take loans. This will make companies to take debt, use the debt profligately, and not have virtuous operating cash cycle. Many companies which became non-performing assets and for which the insolvency and bankruptcy code had to be brought in reflect that kind of approach. Opportunism-driven liquidity drove such companies to profligate use of debt. Overall, of the several hundred cases that got referred to the bankruptcy courts, the recovery was 1.05 trillion rupees out of 2.32 trillion rupees that were involved as the total outstanding debt levels. Of these, the leaders were the 9 companies, the first 9 companies which were in the steel making and other infrastructure sectors. The recovery rate there was high at 56%, mainly because the assets were world-class assets, only thing they were run in a poor manner. This made those companies non-performing assets, and acquirers could pay a better price for acquiring those assets. And those acquisitions were made at the right time, because before the steel super cycle started in 2020 and 2021, those assets were in place as part of the IBC acquisition in the original steel companies and other infrastructure companies. So opportunism-driven liquidity drives out promoters, managers who don't manage that liquidity well, and they become candidates for acquisition. There have been several other resolution methods, including SARFAESI Act, but the recovery rate there has been much lower. Opportunism-driven liquidity could be beneficial with good management and leadership, but that is purely opportunistic, and such opportunistic debt or equity raising without good management would be counterproductive. Just because liberal private equity investors are putting money, that to huge amounts of money at high valuations in startups, If the startups do not try to have good operating models with good profitability in good time, this could all be leading to an investment bubble without any commensurate return, and it could also blow up in the face of the economy at some point of time or the other. So as managers, as executives involved in operation, execution, and as leaders who are leading the industry onto a growth path, the important aspect to remind is that we should be having system liquidity that is opportunity driven and not opportunism driven. We should have management which takes good cognizance of economic factors and industrial factors and related competitive forces, but we should manage our industries, our firms in a prudential manner. Then only the true economic wealth and true economic value will be generated out of these expansion and diversification initiatives. So, liquidity and strategy are very much interrelated. Undoubtedly, enhanced investments and operational synergies will be there when corporate plans and business models are made based on 5 forces theory. However, incorporation of system liquidity is a reality check. On one hand, it makes the strategists take the leap of faith into an aspirational future supported by liquidity. But it should be used also as a reality check, where I am taking this company in terms of the financial norms. When we are able to balance all the 9 factors of financing and supporting strategy and resultant outcomes, then we will have an integrated liquidity strategy along with the competitive forces model. So equity finance, debt finance, internal generation, they belong to one group. Liquidity elasticity, institutional strengths, management strengths belong to the other group. Market capitalization, economic growth, and the opportunity spectrum that is available belong to the third group of outcomes. So when financing is supported by management, the appropriate outcomes will come about. These factors, their contrarian ones, and more such factors need to be stress tested. That is the real test of good liquidity-oriented structural and strategic analysis. Stress testing of all the factors that benefit from and have an impact from liquidity must be stress tested. Firms would do well to seek economic optimization through a model that focuses as much on collaboration as on competition in respect of these factors. We therefore look at not only the system liquidity as an influential factor on competitive strategies, but we also look at collaboration as an influential factor in development of industry and individual firms within the industry. With this, we come to the end of this lecture. Thank you.